Hi, everyone. Thanks for being with us once again. I'm Hal Levy at Payment.com. I'm joined today by Scott Simpson at Capital One, and we're happy to have you and welcome.
Thanks, Hal.
We're discussing B2B. Specifically, we're discussing what might happen if we reimagine B2B account receivable processes, alternatively AR, in a consumer-driven world. An ambitious undertaking, but certainly one with rewards. When we think about it, what are the driving forces that motivate a business to think about transforming, to reimagine what they're doing, how they manage their B2B accounts receivable programs? What are we seeing out there in the field?
Well, thanks, Hal. First, I don't think most businesses wake up trying to reimagine accounts receivable. I think they're very focused on how do they win and keep the sales that they have and the customers they have, and also what are the factors that drive profitability. And I think now the reason why accounts receivable is increasingly in the focus is that it's a new front for competition. I think as customers or consumers, last 15 years, there's been so much change around how we buy and purchase and experience an interaction. But on the business side, it's really stuck in 20, 30 years ago, much the same. It's very manual, clunky process. So if I'm a business customer and I buy from a merchant or a supplier, I get a paper bill. If I needed support, I got to call during business hours. It's just not very convenient. It's not tech forward. It's not digital. It's not automated. And so quite simply, customers are looking for better, either, a given merchant or supplier is going to provide that, or customers are going to find it elsewhere. It's also in this environment too. Last year we've had a lot of change in interest rates, and also from an economy perspective, I think there's certainly greater chances of recession. And so if a merchant's managing their own accounts receivable, they're effectively lending their own money out, which is a lot more costly. And then in recessions, not everybody pays back. And in general, actually, not everybody pays back. And so I think the costs of managing an accounts receivable are becoming more challenging. So if you put those two together, customers are demanding it, and there's sort of more profitable, better ways to manage it. I think that's why CFOs and heads of finance are looking at better ways.
You mentioned some costs, you mentioned demand, you mentioned all these things coming together. So with all of that out there, what growth opportunities should arise from reimagining the AR processes? And specifically, let's talk a little bit about the ways in which firms can improve transparency, visibility, by extension, that cash flow that's so critical when they are actually transacting day to day.
Yeah, that's a great question. I think we start with, how does your accounts receivable either help or hurt in winning customers? When somebody provides a net 30 or net 90 terms, so they're giving 60 days or 90 days for somebody to pay, that means they're also not getting the cash for that. And oftentimes merchants feel like that's an inhibitor for them to extend longer payment terms. On the other hand, customers like to go and to those companies that provide them those type of benefits. So one thing that Capital One Trade Credit provides is the ability to provide 30 or 60, 90 or 120 day terms, but we're going to fund the merchant right up front, and so you can get the best of both worlds. Also, I mentioned before, the experience is really critical for customers and how they buy, and so if a merchant has the ability to apply for an account online or get their bill online or pay online, they have all this visibility to transactions that it really makes it easy to do a business with a merchant supplier. You might be surprised to find that virtually no businesses on their own have built out the ability to online to check into your account. They need to use third-party services for that. And so again, as a consumer, you kind of expect you can go do that, but you can't really do that in most accounts receivable programs today. And so those are some examples. There's also other things that just in this day and age with data available, having the ability to pre-screen for your sales team, who are the customers out there you're trying to win with, and are they good for your program from a credit perspective? Are they good for your program from a a size. Those are the type of things that if you're not able to do that on your own, you should be working with an accounts receivable partner to make that happen.
None of this is easy. None of this is intuitive sometimes. When we're thinking about the reimagining that we're talking now, at this moment, there are any number of challenges that I think we could discuss when we're thinking about them. What are the challenges that businesses face when they do this? What are the bottlenecks that may come operationally, that may be technological in focus? And even more than that, what's the mindset shift that we might have to see when we think about doing this? And how do you go to market and do this? How do you have the right partners in place? What should you do?
I think the biggest bottleneck or challenge is just the inertia of what merchants have today. They have their accounts receivable program. It works. They do send out bills. They do collect money. They do transact. And I think it's sort of like, like a car that might have some dents in it or might not always be super reliable. If it gets the job done mostly, you tend to stick with it. I think the challenge is as the changes in expectations for customers start to, manifest themselves in them going to different suppliers where it's easier to do business, or, merchants start to lose traction. I think that's when, this inertia starts to get broken. And so I think the biggest part is just the mentality of change is here. It's coming. I'm not actually here to debate like whether the internet is going to transform how people interact. I do think it takes time, but you are seeing that, really that there's going to be a tipping point where either you have a progressive, modern customer experience or you don't. And I think those that choose to act sooner are going to be the ones that tend to win customers and delight customers and keep them. Those that don't will steadily watch, their businesses erode.
You're alluding to it now, but I think we can maybe broaden this part of it. With the bottlenecks, with the challenges, with your reimagining, there are risks. And I wonder if those risks are in execution, if they're in security, or even if, to your point, obviously it's a competitive factor. So what are the risks as you start to reimagine the age-old process, the way it's already been done, or comfort levels? What are the risks that are out there?
Sure. I can speak to, if you're going to partner with Capital One Trade Credit, or if you're going to partner with an accounts receivable automation company, there's sort of two things that show up as risks almost always. One is just there is a level of effort that it takes to do something new and a learning curve. And so those changes are really important to be well understood and well supported. Any merchant or supplier that's looking to do something different should make sure they look into, what the track record of those third parties are. The second is anytime accounts receivable touches customers, and my experience has been every time you change anything with a customer, there's just heightened sensitivity because you're not changing, something that's just back office. You're actually changing something that does interact with sales and with relationships and things that, and think, so there's a lot of fear that goes with that. I think, as I said, part of the process here is to make sure that the customer experience that you're trying to get your customers to, which is, going to be much better for you and for them, just explaining them what the process would be. And I think that makes both the effort that I said up front sort of easier to understand, and also the benefits. There really isn't, the efforts tend to be lower in sort of complexity and challenge and effort than people think. And also, I think people tend to think that customers, because they're not complaining actively, really like their existing structure, when in reality, I always think about the time where way before you had, Google Maps on your phone, like I didn't need directions, but now I can't imagine getting into a car and not plugging in, navigation. And so I didn't know I needed it. But on the other side, I would never, ever go back to not knowing where I'm going when I'm in a car. It's the same kind of thing here. I think once the customers are on the other side, they're going to love it. And the time savings and the ease of doing business with you is the key.
That's a great point. You didn't know you needed it till you have it. Now you know you need it. with all of this comes the need to collect, analyze, and more than that, act on data. What are your thoughts about how data and analytics and the insights gleaned from that data can be leveraged to optimize this reimagining that we're talking about? I wonder if you might be able to give an example of how you might be able to drive business growth with the right information at hand. And by the way, what is the right information?
Right. Well, one of the things that we equip our merchant partners with is pre-screen capability. So we have more data than they do around the credit quality of customers they're trying to win with, and we also have more information that can help them predict the right fits and the right opportunities for their sales teams to go after. If you take what we have and merge it with them, it ends up being almost a turbo boost for the sales team, because they can go out and say, hey, like, I will target the right customers, and also I'll know, hey, you're already set up for a net 60 or net 90 account. You're already approved for $50,000 line. Come over to my business. So we really aid in that process up front. Also, there's just a wealth of information that helps separate out those that are really risky or really fraud concerns versus those that are actually just, maybe they have seasonal payment cycles and are just lumpy in how they pay. And if you don't know the difference, then you're not able to correctly figure out who to approve or what lines to offer them, or when or if you need to spend effort collecting. Those are types of things that are really powerful if you have data scale that we do. Data is also information that customers provide today, and so do merchants have a good way of understanding how their customers want to be served? In our system, we're providing opportunities for customers to set up their own notifications and their own preferences, or if they want to add users or take away users, or add functionality, or or make a dispute online, anything they want to do, really putting power in a customer's hands to say, this is how I want to interact with you or don't want to interact with you. I think if it's 31 flavors, but effectively one flavor, then it tends not to actually serve what people want. And so there's a lot of information that's available. You just have to have a tech platform and a service model that enables you as a merchant to provide the service that you want. And again, in our experience, customers are different. And so you have to have an ability to manage it in different ways.
I think that's a great conclusion. The data's out there, the information's there. It's what you do with it that counts. And you have to be able to be a little bit, let's say, tailored approach to using all of that. And I think that's great. And certainly the benefit is out there as you start to reimagine what we do here in the back office, because it has all sorts of ripple effects out there in the real world. So great point. I want to thank you for the time. Scott, it's been a pleasure.
All right. Thanks, Hal. I appreciate it.
Great. Thank you.
Bye-bye.